Welcome back. I've got Alexander Ineichen on the line. Alexander, how are you?
Fine, thanks. Yourself, Mike?
I am awesome. Really looking forward to this conversation. So why don't you share a little bit about you and what you do?
Okay, I'm 55 years old on Sunday, actually. I've been in finance, financial analyst since the late 80s. I'm based in Zurich and London, mainly. Since 2009, I've got my own firm called Ineichen Research and Management. My client base is actually institutional investors, mainly like pension funds, insurance companies, banks, hedge funds, asset managers, family offices, that type of client base. I sort of grew up doing research on risk management. So I started out in derivatives research, and then later I did research on hedge funds. And now I call my research risk management and nowcasting research. I'm happy to talk about that in more detail. And I'm based in Switzerland, married, 4 kids, and I recently published my 3rd book.
Well, congratulations on all of that amazing work. Before we dive into the new book, I want to talk to you a little bit about, especially you've got, a focus on risk management right now, and especially in the world that we are in at this particular moment in time, with the COVID pandemic still kind of lingering on a little bit. There's inflation in certain parts of the world and cost and supply chain challenges and all of that. And then, of course, the conflict in the Ukraine as well. These are all situations that investors and the markets hate uncertainty. And it just seems like right now there's an absolute ton of uncertainty in a variety of different areas. So, what's your observation on what we're seeing in the world right now? And again, not investment advice, but what are some things that you do and you've advised your clients and the people that work with on how to navigate through all of this?
Yeah, well, first, the one reason I do nowcasting is because I don't believe you can predict the future. So I believe, let's say, the economy and financial markets are unpredictable by definition. And the reason is that they are chaotic. Chaotic means like a small disturbance can have a large impact on the outcome. And the typical example is that a butterfly swings its wings in the Amazon, and through lots of a chain reaction, essentially, that causes a tornado in Texas. And 2020, it was something very small in February that changed everything, right? Small as in the virus, we need a microscope to see it. So a small disturbance in February, made obsolete all the forecasts for that particular year. And almost the same thing happened this year, right? The small disturbance and small as in, an event which wasn't on the radar to a large extent in December, like the invasion in February, changed everything. That's why I do nowcasting. And nowcasting, you just go with the data points you have every day. New information comes and you assess it, and there are trends. It's not everything is random. That's not what I claim at all, but there are trends. Like, for example, since mid 2020, I sort of tell my clients that we are in an energy regime, which is very different from a tech regime, tech as in technology. And one way to show that over the decades is, for example, by the relative performance of technology stocks versus energy. That's one way. Or you can also actually compare the Canadian stock market with the American stock market. And if you overlay these two relative performance measures, you see that for about 12 years we were in a tech regime, which everything sort of comes like the FANG man, as in Amazon, Apple, Netflix, and so on, did well. The whole tech sector, and it includes parts of consumer discretionary and communication services. And then that changed around in 2020, second or third quarter, and now it's sort of like the opposite, right? What the tech regime is not doing well, whereas everything which has to do with fossil energy like gas or oil, and also food. A lot of food like fertilizer has a lot to do with fossil energy is doing well, right? And these trends, they can last for years. And as a nowcaster, I just say we're in that regime, but I don't say it'll end in October 2026. That's what I don't do. Right? I just go with it until I can measure objectively that something has changed.
I think that's a great way to approach it, because again, you're dealing with information that you have here and now. We don't have information from 2026. It's not here yet. Yes, we can project, we can guess, we can look at previous models and trends and whatnot, but at the end of the day, things can change. Like you said, just a little minuscule thing like a virus that ran rampant across the globe, or a conflict between two countries that has a gigantic ripple effect on supply chain because of sanctions and supply and who's supplying what. It does bring to light concerns when you have what I like to call a singular point of failure, where if the majority of the world is getting a particular resource from one region, and that one region becomes compromised to one extent or another, it has a gigantic impact on everything, which of course impacts all aspects of life, not just supply chain, but food and fertilizer and energy and all the things that we consume and we take for granted, quite frankly. And when those things get impacted, we feel it, not 6 years from now, we feel it right now. So then I love how you approach that with looking at things right now, where are they at? And as you're looking at that information now and over the next few years, you'll notice when things shift. It's like, okay, now we're seeing a shift, and it looks like we're potentially segueing out of the energy side of things and going into whatever it will be, whether it's going to be AI investments, or who knows what's going to be, the world's going to look like in 2026. Not that far away, but basically the way we've been innovating over the last few years, it's amazing how much things can change in a very short period of time.
Yeah, last week actually was very special from a risk management point of view, because the correlation was extremely high. So like everything did poorly, or even like gold, which is sort of like perceived rightly or wrongly as sort of like a bit of a hedge in times of inflation. Nothing last. Just if you look at just 1 week, and you can include this Monday, like yesterday, everything sort of like failed, and that is sort of like a bit the nightmare from a risk management perspective, because what you do is you try to learn from history, and so you look what does well in a difficult environment like we are in now, and one sort of like small sector is gold mining or gold. Another one is defense, which has obviously it does well if the geopolitical risk increases, and now it didn't just increase like a new war started, and so that's why it makes sense to look at smaller sectors or industries to find pockets of let's say investments that are sort of like loosely correlated with let's say with a 60-40, like 60% equities, 40% bonds portfolio. But last week was just a very special case where correlation was almost one, among investment, among broad investments like equities and bonds, but also within those pockets which typically have sort of like a bit negative correlation when in difficult times.
Yeah, when you look at your investment portfolio and you see red across all the platforms, the best thing is just shut down the computer, go buy a cup of coffee or a tea, and go outside and just get away from it, because a lot of times I know in talking with investors, they panic and they And when you panic, that can be detrimental to you as far as your long-term or even short-term investment goals. So, and again, this is not a show about investment advice, just information. But I know when those days where you kind of look at all the different markets, and I saw that yesterday too. It was like, wow, what in the world? And it's like, okay, this is going to cause some uneasiness for a lot of people. And from a risk standpoint, hedge fund managers and all of that, they're looking, okay, what's my hedge? It's like my head, I need hedges for my hedges. And it's,
I mean, in terms of panic, there is this famous saying that if you have to panic, panic early. Obviously, that is much easier said than done. But one of the situations we're in 2022, that a lot of the stuff is actually not predictable, but determinable from a nowcasting point of view. So, for example, the macro situation in most countries has been getting worse over throughout the whole year, even prior to the war, and you can measure that, for example, with GDP forecasts. You can measure are they falling, and then you can measure how strong they're falling. Are they falling mildly, or are they falling sharply? And since the war began, they have been falling very sharply. The closer the economies to the war, like Eastern Europe mainly, but also Germany. But then if you go to Australia, it's a different situation. And also, for example, Brazil, India, they are completely, I wouldn't say unaffected, but you don't see it in the revisions data. So that gives you sort of like a clue what is going on without any predictions at all. You just need, well, the information, obviously, but you don't need to predict to make investment decisions. And one of the funny things, I would say, well, funny in quotes, is that the earnings. It's also something I look at. It's sort of like the bottom-up stuff I do from a nowcasting perspective. They haven't worsened. I wouldn't say at all, but they are the downward revisions. If there are downward revisions, are very mild in most cases, and that's not necessarily how it always works. Normally, it's sort of like it's sort of like correlated, that you sort of like the economists bring down their forecasts, and then the stock analysts respond to that, and then we can start measuring it by looking at like on a sector level. But this time that is different. So earnings have not been revised downwards to any large degree. There are some exceptions to that in some sectors, but generally speaking, let's say if you look at the main sectors of the MSCI world on that level, it's the downward revisions are abnormally mild given how strong the macro forecasts have been revised downwards.
Yeah, I think it was the S&P 500. I think a third of the S&P 500 are announcing their earnings this week. If I could be wrong, but I remember seeing that just on a headline somewhere. It's like, and I agree. We're seeing a lot of companies that aren't showing a gigantic drop off in profits. Again, I agree with you. There are some sectors that are going to struggle a little bit more, but some are rebounding and are doing well. So it's really going to be interesting to see how this plays out. So definitely want to spend some time on your book. So tell us about the new book.
Well, it's called Applied Wisdom, and the subtitle is 700 Witticisms to Save Your Assets. And I see it as a risk management book, but it's very casual. It's a very casual read. I started writing as a financial analyst, as I mentioned, in the late 1980s. And I started using quotes just to spice up things a bit. I enjoy quotes and I collect them. So now, 30 years later, I have quite a selection. And I put that into a book. So normally when I write research, I start with the content, and then in the end, I might find a Winston Churchill quote, which works well with the content. Now, for this book, I turned things around. I started with the quote. So I take a quote I like, let's say, Churchill or Keynes or whoever, and then I add some content to it. So it's sort of like I see it as a risk management book, because it's sort of like it's sort of like that is sort of like my core expertise, and I always fall back to my core expertise. But there's a lot of other stuff in there which it might not be that much related to risk management.
I love that format. I'm a fan of quotes too. I've got a book that I picked up several years ago at a JW Marriott. I was speaking at an event, and they had a little shop that had like golf clothing and attire and things like that. And just by the cash register, they just had this book. They didn't have, I didn't see any other books in there. They just happened to have that one. And I looked at them like, you know what, this looks interesting, and it's small, so it fits in the luggage really easily. And I go back and I look at it time and time again, and you just because those quotes will get your mind moving on things, because they paint a picture, and a lot of people that look at quotes and they get amazed, and I do, and I understand, just because of humanity and everything like that, that a quote that Winston Churchill said so many years ago is applicable right now, as if he told it to our faces today, which he did.
Yeah, one of the claims I make in the book is that often, we have obviously we had the scientific revolution a couple of hundred years ago, and let's say in finance you have, let's say, modern portfolio theory. So in the 1950s and 60s, you had Harry Markowitz coming up with portfolio selection, where he proved mathematically that it works, that diversifying reduces risk. But the wisdom behind that is thousands of years old, right? It predates even science, right? We only have science as we know it today for the past couple of 100 years. Before that, it was called something else, like philosophy or thinking or whatever. And so what I claim is that you can trace some of these quotes and then find an entry from a scientist. Like in finance, it would be Harry Markowitz, and in health, you say, an apple a day keeps the doctor away. That's extremely old, right? And it predates the scientific proof that it's actually true that a lot of fruit is good for you, right? So the book focuses on the wisdom and not necessarily on the scientific proof of the wisdom, and some of the ideas we perhaps take for granted, or we call scientific today, are thousands of years old.
The apple a day story reminds me, I used to work in healthcare, and one of the doctors that I worked with was actually allergic to apples.
Yeah.
And so I said, well, I don't think that's what they meant by this, but whenever he's like, I have a meeting with you, it's like, okay, let me grab an apple. He said, you don't want to meet with me, do you? It's like, not today, but it was a running joke that we had. But ultimately, it's, again, those sayings that go back hundreds or thousands of years, they're applicable today. So in closing, a thought came to mind, because I think a lot of people, especially in investing, and we've talked about this before a bit, they're looking to the future. How can somebody that is so future forward looking on things kind of shift? And I know the answer is like, study your work, because they'll be able to do it. But how do you get to the here and now? Because not just in investing, but in life, I think so many people are worried about the future and all of that, instead of focusing on the data and the information that we have here right now. So, what's some tips that you could provide people for that? Just kind of help them get a little bit more narrow focused, whether it's investing or just even in life.
Yeah, well, one, obviously, as a researcher, I suggest to be a realist rather than an optimist. But now I think last week we had 52 years, the 52nd birthday of Earth Day, right? And it's sort of like environmentalists started that I think in 1970, which 52 years ago, and there were some sort of like entries into in Twitter or in social media claiming that every single prediction is actually wrong, right? So it's an extreme form of fear mongering. You have that with climate change. You know, in the 70s it was the Club of Rome, and today it's the IPCC. So today it's UN sponsored. But you also have that in finance. I mean, every day you could read someone predicting a crash is just around the corner. And I don't think that's a very good way to invest. You cannot be scared all the time. I mean, we know that economies, you know, free economies, capitalist economies, they expand. You know, typically the companies, when they're taken together in an index like the S&P 500, they make money. Otherwise, they sort of like disappear and are replaced by other companies. And as an investor, you can participate in that. And I think that long-term focus is the most important thing. So you can, when you do risk management, you are a bit short-termist, because every day, you know, a meteor, you can hit by a car or a meteorite, but that's not the way to invest long-term. You can think about these things, but I cannot imagine a good investor being scared all the time. Although that said, we shouldn't forget that in my lifetime, let's say over the past 20 or 30 years, investment lifetime, I mean, the S&P 500 was the gold standard, right? It just went up, and even 50% drawdowns were recovered shortly. But in the 1980s, it was the Nikkei 225, which was the gold standard, right? And it went from 40,000 to 7,000. So that doesn't mean we should be scared that could happen with the S&P 500, but I think what I'm trying to say is we shouldn't ignore history. I mean, we should, pay attention to, things changing. And that is sort of like it's a bit a cliche, but, there's a cliche that there's only one constant in the universe, which is change. Things always change. And from a risk management perspective, yes, we have to, every day, in my case, or as an investor, on a regular intervals, we have to, analyze things and pay attention to change, but without sort of like being scared that the world is going to end within, 3 months or so.
I love that. That's great information and insight to share with everybody. So, Alexander, I've loved this conversation. Where can people find out more about you and all this amazing work you do?
Well, I've got a website, which is my surname. It's Ineichen, then -RM for riskmanagement.com. Or if you Google my name, you should come. I've got a website called alexanderineichen.com. And yeah, that's where to find me.
Awesome. And I'll definitely have all that information in the show notes. So again, Alexander, thank you so much for your time today. Really appreciate you and love this conversation.
Thanks for the opportunity. Okay.